Welcome back. In today's video, we're going to be covering a few things. We're going to talk about 3 stocks I bought this week, my 2026 watch list. I'm going to show you my portfolio and how it's done this year. Then we're also going to look at the rate cuts that happened this week and what it means for the market. Let's get right into it. First, let's go over my portfolio. Now, if you watched my videos before, you know I have 2 portfolios, with this one being one I started in June of this year. The purpose of this portfolio was to build it alongside Stock Study. So I started posting on Stock Study at the same time I opened up this portfolio. And it's been a way for me to show you guys everything I've done. In this portfolio, I hold 7 stocks. I hold Duolingo, Adobe, ASML, Google, Amazon, Nike, and QQQM, with 4 stocks leading the way. We have Duolingo and Adobe taking up about 45% of the portfolio, and we have ASML and Google both around that 20% of the portfolio. So those 2 stocks alone are taking up about 85% of the portfolio. I've had a lot of success with both Google and ASML. These were ones I was talking about a lot over the summer, so June, July, August. These are stocks that had pretty bad sentiment around them. They had pretty bad performances leading up to their big explosion, but now they're doing well. Google is up over 75% for me. ASML is up almost 50% for me. We look at my top 2 holdings, Adobe and Duolingo. They haven't done as well, but I've been buying so heavily lately. Duolingo is the only stock I'm down on now. I'm down about 7%. And just about a month ago, I was down way more than this, probably 25 to 30%, but I've been averaging down because I believe in the long term of this company. And I don't mean just a few years, I mean a decade plus. Now, we'll get into that more later, but this is what my portfolio looks like. Now, the reason Amazon and Nike take up less of this portfolio is because in my other portfolio, I own a lot of them. Amazon's actually my biggest in that one. I think Nike's my 3rd biggest position in that portfolio. But this is the only portfolio I'm buying in now. The other portfolio is what I was buying at the start of my investing journey. And this one is the most up-to-date, most recent one, the one I'm fully transparent with. And then also my QQQM position, this is one I'm dollar cost averaging into daily, a very small amount. This is more of a foundational piece. This is where if I don't totally know what to buy, I could put my money into here and let it grow over the long term. So that's my portfolio. I'm up over 16% since June of 2025, which is beating the market by a few percentages. But I'm a long-term investor, so I'm not worried about how much I'm beating the market now. I'm looking more 5 to 10 years down the road. How is my performance compared to the overall market? Now I want to talk about the market, the fear and greed index. It's been a crazy year. First off, back in April, we had the tariff crash dropping over 20% in such a fast time, and we had a V-shaped recovery. The market recovered so fast. Once it hit the bottom, we had a 7% recovery day, which was crazy. But we looked just a few weeks ago. I mean, now we're in neutral. We're at 46, but we were at a 6. We were in extreme fear, and everything felt like the market was crashing. Everyone made it seem like the AI bubble was popping, and it was terrible. The lesson here is the market is just so volatile most of the time, and you really don't know what's going on, and no one really knows what's going on. The market could be down in the trenches one week, and the next week it's at all-time highs, and that's kind of where we're at right now. All you could do is really control what you're buying, understand why you're buying it, and stay consistent. So that's what I've done. So now the next major thing that happened were the rate cuts. Wednesday, December 10th, we saw the Fed cut rates. And I want to kind of recap that and what it means for the market and buying stock. So if you don't know what happened, the Fed cut interest rates by 25 basis points. And this was lowering the range to 3/2 to 3 3/4%. This is the 3rd consecutive rate cut of this year. During this meeting, the Fed also stressed data dependence, and they were giving no promises of a continued rate cut cycle. Now, they mentioned inflation is still slightly above target range, but cooling enough just for the Fed to justify easing. We also saw that labor markets are still softening with slower job gains, and this is a key reason for their easing. And then they also announced a treasury purchase program to stabilize money markets. And this was more of liquidity support, not a quantitative easing. So what does this mean exactly for the stock market? I mean, that's the most important thing as investors is how does this influence the stock market? So first off, we could go over the bullish factors of this, the bullish forces. So lower interest rates mean higher valuations, especially for tech and growth stocks, as it becomes cheaper to borrow money and the rates for bonds and treasuries are cheaper. More money is going to flow into riskier assets like the stock market. This means we'll start seeing higher valuations, so multiple expansions. A stock trading at 25 PE ratio might go up to a 27, 28 PE ratio, and it's going to benefit a lot of growth stocks. Then also, the market sees this as a soft landing signal. What I mean by soft landing is inflation falls, the economy stays healthy, and no big spike in unemployment. This is good because the Fed thinks inflation is manageable still. That was the bullish stuff. What are some things we need to be cautious of? What are some cautious flags? So the Fed did not signal more rate cuts. This means the market may be disappointed if they priced in an easing cycle. If inflation stalls or reaccelerates, the Fed could pause or reverse, and that could hit stocks heavily. And then also, softening labor markets mean earnings risk if economic growth slows down too much. So what's the bottom line? What are the key takeaways we could take from this? Well, first off, if we're looking in the short term, stocks are likely to move higher. And this is likely to be coming from tech, growth, consumer sectors. Again, when borrowing money is cheaper, we're going to see more money flow into the stock market. When we're looking medium term, we could expect volatility. The Fed is not committed to a long easing cycle, so each new inflation or jobs report can swing markets. And then finally, long term, which is what I care most about, the cut supports the soft landing narrative, which overall is positive for stocks if inflation continues to trend down. So with the news of rate cuts, the market is slightly up, but we're at all-time highs again. I mean, if we go back to just a few weeks ago, Thursday, November 20th, the market was down a lot. We were close to an 8% dip in the NASDAQ, so we almost saw a correction in the NASDAQ. The S&P 500 was down 5%. But when we zoom out and go year to date, the market is still up over 17%. Even with the tariff crash, even with this little dip right over here just a few weeks ago, we're at all-time highs. The market is still growing. And this is why it's just always important to stay invested in the stock market. That's why I am so focused on the long term, because the short term is really just unpredictable, whereas the long term, companies are going to continue to grow, people are going to continue to spend money, and the best companies in the world are going to ultimately become more valuable to own. Okay, so now I want to get into 3 stocks I bought this week. Now the first one should be no question if you've been watching my videos. It's Adobe. They actually just reported earnings yesterday. I posted a video about that right here. If you haven't got the chance to watch that, I'd watch it. I mentioned it in this 2 stocks I'm buying this month. I have a 26-minute deep dive on this company. It's a company I've been talking about a lot, a company I love, and a company I think is ultimately incredibly undervalued. So to kind of recap the earnings, we go to revenue, all-time high revenue. They ended this year at $23.77 billion of revenue. They reached a new all-time high in total performance obligations. So this is almost like guaranteed revenue. $22.52 billion. Free cash flow continues to rise, so close to that $10 billion mark. EPS is also at an all-time high, $16.71 per share. Net income up, EBITDA. And something else that's incredibly impressive is they bought back over $12 billion worth of shares this year alone. That's over 6% of the shares outstanding on the total market. Now again, I made a video about this yesterday, so I'm not going to go too much in depth, but there's a few things people need to understand, because the main narrative is that why should I use Adobe if generative AI does just a good enough job that Adobe does? Well, first off, Adobe is implemented into these generative AI models now. One of the biggest things that came out of the earnings report was Adobe tools are integrated into ChatGPT. So right here on Qualitrim, it says, Adobe announced that Photoshop, Adobe Express, and Acrobat can now be used directly inside of ChatGPT, enabling image editing, design, and PDF workflows via chat and exposing its tools to hundreds of millions of chatbot users. Users must register with Adobe, potentially expanding signups and usage while embedding Adobe more deeply into the broader AI ecosystem. So again, we see the competition, ChatGPT, Gemini, whatever you want to call it, the generative AI, we see the competition partnering up with Adobe because they understand they can't beat Adobe. One, Adobe has insane switching costs. They have an ecosystem of over 50 plus apps. If you want to switch out of that, not only do you need to find a service better than those 50 apps, the entire ecosystem, but then you have years of your data, your workflows on Adobe. We also need to understand Adobe is for professionals. 90% of Adobe's revenue comes from professionals themselves. So these professionals are working at businesses, whether they're small marketing agencies, mid-sized businesses, Fortune 500 companies like a Coca-Cola, Nike, Disney. These are companies that need to collaborate with other companies. And ultimately, when thousands upon thousands upon thousands of companies are working on Adobe, you can't switch off because then you can't collab with them that easy and you fall behind the market. Another key factor I want to bring up is they announced in the earnings report that 1/3 of their annual recurring revenue comes from AI now. They are one of the few companies, one of the few big tech companies that can actually show proof that AI is helping them make money. And it's not just this big CapEx. We look at the stock chart for Adobe. This is a stock down over 28% over the past 5 years. The past 1 year down 26%. Year to date down 20%. This company is just incredibly undervalued. We have a forward PE ratio of 15 now. And this is a company that has showed zero signs of slowing down. I mean, over the past 10 years, look at the revenue growth. They're growing revenue over 10% a year right now. Over the past 5 years, over 13%. It's just, there are no signs of this company slowing down. I could talk about this company forever, and I have in the past. You could click this video, this 26-minute Adobe deep dive, if you really want to understand why this is such a good deal. You could look at my Q4 Adobe earnings report video. I also have one from over 4 months ago right here. That one's a little outdated. I did a much better job on my newest one, but I have all the resources. If you don't like Adobe, but think there's an opportunity, I'd go watch those videos. I think Adobe is still incredibly undervalued. I think fair value is way closer to a 500 to 600 range. So even though the stock is up just a little from its $312 low, it is way undervalued. I am buying so much more, and I'm probably going to make this my biggest position in my portfolio. So now let's get to my second stock I've been buying this week. We have Duolingo. This is another one that's probably no surprise to the people that stick around. I've made multiple videos, one a month ago on my Duolingo deep dive. I have another one after the Q3 earnings report, and then I have 2 more following that. This is a stock I've talked about so much because I think the opportunity, I think the trajectory of this company over the next decade is quite literally incredible. Over the past 6 months, this stock is down almost 60%, year to date 38%. And since it IPO'd, which was less than 5 years ago, it's now only up 44%. It had a huge run up earlier this year, and it's fallen back down, which I think was healthy. I think valuation was way too high. PE ratio was back in the 250s, which really wasn't justifiable. But even when we look now, it's trading at a 45 forward PE ratio. Now that looks expensive on paper, no doubt, but we need to look at the financial metrics of this company. First off, understanding this is a small company. They're under a $10 billion market cap, which in today's market is pretty small. So valuation can get compressed really fast. And when you see growth like this, 41% revenue growth over the year. We have exponential accelerating revenue growth. We have a company that has over 50 million daily active users. They have over 135 million monthly active users. Some of the most impressive things right now is free cash flow growth, growing 55% over 1 year. Over the past 2 years, compounding at an 83% rate. And you look at cash and debt, they have over $1 billion in cash and 0 debt. Now EPS is a little misleading because they had a huge tax benefit. They beat expectations by like 300%, which wasn't accurate, but even subtracting that, EPS continued to grow. Now, what we need to understand with Duolingo is the data advantage they have. If you don't know what Duolingo is, they are a gamified learning language app. This is an app you could download on your phone and take daily lessons for free, or you could buy a subscription and learn 40 different languages around the world. And actually recently they added chess, music, and math, which have been greatly successful, especially chess. That's what I'm learning. I have almost a 70-day streak now, and I've actually learned a lot. But this is an app that's supposed to make learning fun. You're supposed to log in for 5 to 15 minutes a day, take 1 to 2 lessons, and sign off. What people don't understand is this company is trying to become a personalized AI tutor for billions around the world. Not millions, but billions. What gives them the advantage is the data they collect. In the world of AI, data has become so much more important, especially personalized data. Data only Duolingo can collect. So every time someone completes a lesson or makes a mistake or even just taps a screen, it feeds Duolingo more data. This is data that no LLM has, no big tech has, only Duolingo. This is personalized learning behavior data. What they then do is take that data, that learning behavior data, put it into AI models. These AI models generate better lessons for faster, cheaper, and they're more personalized. Those lessons attract more users. Those users attract more data, and that data goes back into the AI models, and it's a rapidly reinforcing flywheel. So why Duolingo? Why Duolingo over any other educational tech platforms? The biggest thing is their gamification. Because it's gamified, because it's supposed to be fun, when you have over 135 million people logging in monthly to complete lessons, you're collecting way more data than everyone else out there. And then what happens is, once they added AI, once they started making lessons with AI, helping them assist with making lessons, it took them 12 years to build 100 courses. Last year alone, they built 148 courses because of AI. So we have 12 years, 100 courses. But then we have 1 year alone and 148 courses. So we are seeing a company rapidly accelerating the quality of their courses, of their growth, because of AI. Now, there's arguments that why would someone have to learn a language because of all these AI technologies? There's one thing we need to understand. Since I started Duolingo over a decade ago, technology to help you translate languages has always been there. Every year there's been new technology, and there's not been a single slowdown for Duolingo. Users have continued to grow, subscription revenue has continued to grow, revenue has continued to grow. So there's that argument. The other argument is they are not looking to just stay as a language learning app. They are looking to go into what they already have done, math, music, and chess, But then you talk about writing, you talk about financial literacy, you talk about coding, you talk about history. They are looking to expand, and they already are expanding because they see all this opportunity out there. So yeah, even if you want to say language is going to be overtaken by AI, that's not their plan. Their plan isn't just to stay in this language subject. So again, this is a company I'm buying so heavily right now. If you want to learn more, I have multiple videos on my channel, but like I showed you, this is the biggest stock in my portfolio, and I don't plan for that to change much unless it's Adobe taking that over. So now let's go into stock number 3. This one is one I don't talk about too much, but it is Nike. Nike's an interesting story. They are in the middle of a comeback story. When we look at financials, it looks pretty poor right now. Revenue over the past year has dropped over 7%. We see EBITDA falling, net income, free cash flow, earnings per share. And then we look at the stock price over the past 5 years, down over 50%. This is a company that is being destroyed right now. Now, the drop in these numbers are intentional. They are fixing a lot of things that past leadership did very poorly. Now, I explained all this in my first video where I showed my face over 6 months ago. Nike stock has collapsed. Is this the biggest opportunity in 2025? But again, I'm gonna give you the rundown. So what happened was in 2020 to 2024, they had a CEO, an outsider CEO, come in and basically try to make Nike a tech-first company. They were rapidly moving their products to their online app and taking themselves out of stores. The problem with this is they did it way too fast, and it was not very strategic. So what these retail stores had to do was they also had to cut costs. So not only were we seeing cut costs for online stores, we were seeing it for the retail stores. Now, Nike would have to combat that and lower prices again. Retailers would combat that and lower prices again. So all of a sudden, we just have this race to a bottom where Nike products are getting so cheap, margins are getting absolutely destroyed. You're getting to the point where you're making almost no money on your products. Then also with Nike having an elite global brand image, you're hurting the image. When people buy Nike, they want to feel good. You're spending a little more money because it feels good to wear Nike. When everything gets so cheap, you no longer have that feeling when wearing Nike. So that's the one major problem. Another one was 2022 had record levels of inflation. What happens is when you're Nike, you're someone that sells to the masses, but you're a little more expensive than everyone else. You're not Walmart brands or Target brands. You're not these cheaper products, but you still sell to everyone. When you have record levels of inflation in 2022, your customers, the masses, the majority of the market are going to start cutting back on buying your $80 sweatshirts or your $200 pair of sneakers, and that's gonna hurt your margins even more. So Nike got killed during this time, and they brought in a new CEO at the end of last year, and he was with the company back in 1988 as an intern. He's worked his way up. He actually retired a few years ago, but came out of retirement to take over as CEO to help the company. He was with Phil Knight, the founder of Nike, and really saw what it took to build this company up. Now we are finally starting to see the bottom come in. As we can see, revenue hit a low in Q2 of this year, but now it's finally starting to reaccelerate just a little. This is the first sign of the turnaround starting to happen. When we want to look at the current valuations, it still looks a little expensive, trading at a 41 forward PE ratio, but we need to remember, their financials look poor on purpose. EPS is getting destroyed on purpose, so valuation is naturally going to look a little more expensive. But really, this is a stock I've been adding up a lot on. In this portfolio, like I said, it's not a very big position. It's only 4%, but in my other portfolio, it is over 10%. So when everything equals out, it takes up a good chunk of my portfolio. It's a stock I'm very confident in, a comeback story I'm betting on heavily, and Nike still holds that glorious brand image. And that hasn't gone away. Even during all this stuff, there's been competitors, but Nike is still Nike. When you turn on college football, everyone's using a Nike football. When you turn on the NFL, look at what they have on their uniforms. When you look at the NBA Finals, look at what they have on their uniform. It's Nike. Nike still has that premium brand image. They just need the right leadership to turn the story around. And I think that's what they have. So those are the 3 stocks I'm buying right now. And those are the stocks I'm going to continue to buy for the rest of this year. Now I want to get into my watch list. So if you guys don't know, I recently had knee surgery. Because of this is going to take me out for a while in terms of physical activity. And I don't have much to do. So what I did on my TikTok, on my Instagram Reels, was ask you guys what stocks should I research. And I got a lot of feedback. I thought because of all this extra time, let's figure out what people like most and what should go on my watch/research list. So these right now are the stocks I'm researching, already have researched, and are on my watch list. So first we have Iron. Second, we have Micron Technology. Third, we have Nebuous. I hope I said that right. Then we have Netflix and SoFi, which I actually already own SoFi. but I want to continue my research because it's been a while. It's been probably 9 to 12 months since I've truly dived in that company. Now, because I'm still in the process of researching these companies, I want to show you guys my process, how I first start off. And I actually just made a video about this, how to use AI to research stocks step by step. So we're going to use that process in this video. And if you like what you see in this video, you can go watch that one, and I'm going to give you the exact prompt for how I do this. So first, I'm going to open up ChatGPT. You could open up Gemini or whatever you want. And I put this prompt in. Like I said, the prompt is in the description of that other video. But this prompt is going to break down these companies on a 6-pillar basis. So let's take the first one, Iron. What does my prompt think about this company? Okay, so here's what it gave for Iron. So I'm not going to go through all the details, but basically it's going to grade it on business quality, number 1. Then it'll be a growth profile for number 2, financial strength, the third one. We're gonna go to management and strategy, valuation, and then finally a risks and red flag. So the overall verdict gave it a hold and speculative. So the summary said Iron is a rapidly scaling hybrid crypto AI infrastructure company with strong revenue growth and improving profitability. However, the business model carries extremely high risk, lacks a durable moat, and remains heavily Bitcoin dependent. AI compute diversification is promising, but early and competitive. At a weighted score of 5.94, the stock offers upside, potentially tied to Bitcoin and AI, but carries substantial execution and volatility risk, suitable only for speculative allocation, not core holdings. So that's what my AI gave right there. A hold, a speculative hold, and a company ultimately I need to research more. So now let's look at what it says for MU. Okay, so it just produced the answer for Micron. And let's see what the final grade is. So for this one, for overall verdict and recommendation, we have a buy/core holding. So the summary is Micron is a leading memory and storage provider with strong competitive positioning, solid financial health, and long-term secular growth drivers from cloud, AI, and embedded markets. While cyclical risk remains, the current valuation provides a compelling risk to reward profile for a long-term investor. Gave it a 7.5 out of 10. And a buy with a core holding. So now let's do Netflix. Let's see what it has for Netflix. Okay, so I gave Netflix an overall verdict of a buy and a core compounder. Netflix is the strongest financial and strategic performer in the global streaming space. Its business model is now consistent, cash generative, and high margin with multiple optionality levers with ads, gaming, global content. Management execution is elite. Valuation is reasonable relative to moat and long-term visibility. And risk is manageable. Netflix earns a top tier score and qualifies as a long-term core holding. Got a 7.99 out of 10. And again, the buy with a core compounder tag. So that right there is an example of how I start my research project, especially for these companies on my watch list and on my research list. If you own any of these stocks on my watch and research list, please tell me, please give me reasons you own them, things I should look into, and ultimately tools for me to better understand the companies. The number one thing I preach is understand what you buy and why you buy them, and ultimately that's what I'm doing right now. I'm trying to figure out, hey, coming into 2026, is it worth buying these stocks or not? I want to end this off with a few things now. You guys have shown me great support over this past month. I've had a few videos hit over 1,000 views now. This one that came out 21 hours ago has almost 2,000. 3 days ago, this one's over 1,000. My Adobe video did awesome, over 3,000 views. And my goal was to hit 1,000 subscribers before 2026, which I thought that was gonna be pretty hard. But you guys clearly showed me it was possible because we are well over 1,000 now with over 20 days left in this month. And it's honestly exciting. I enjoy doing this. I'm not getting monetized to make these videos. It's just something I like to do. I like to inform you guys. I like to show you my journey, what I'm researching, why, what I'm buying. And it's cool to start seeing it pay off. I'm excited for the journey ahead, especially 2026. I have lofty goals to where I want to be with stock study, but ultimately, just want to say thank you. Then the last thing is, of course, this is not financial advice. I'm not a financial advisor and should always do your own research before buying stocks. If you want me to research any companies or have any video recommendations, let me know. If you agree with my watch list and the stocks I've been buying, I also want to hear what you think about that. Thank you guys for watching, and I'll see you in the next one.